Hi, Assalamu alaikum. In the last lectures, we had a detailed video on International Accounting Standard number 2, the inventories. In this lecture, we will only go through the summary or the lesson learned of this International Accounting Standard number 2. So we will be just having a bird eye view on what this standard says about. So if you don't want to go for the detailed lecture, you will just get the main substance of this standard in this lecture. So we will skim the main parts only. So now this standard applies to all the inventories except the financial instruments under IAS 32 and IFRS 9 and biological assets arising from the agriculture activity under IAS 41. These two will not be included under this standard, except all inventories will be treated under this international accounting standard. These are the two exceptions for only the measurement of the inventories because these two inventories will be measured differently. The producers of the agriculture and forest products and mineral related products and the commodity broker traders. These two, the measurement of this inventory will be different. If you want to have the detailed treatment of this, you can see the detailed lecture. Then we discussed the definitions, what was inventory, held for sale in the ordinary course of business, and the process of production for such sale, and in the form of materials or supplies to be consumed in the production process. Then most important, you will learn this statement a lot, the net realizable value. The estimated selling price less estimated cost of completion and the estimated cost necessary to make the sale. You can say that this is the crux of this standard. When you are practically applying this standard, the people will ask from you that what is net realizable value. You have to treat the accounting at the end of the financial statement, financial year. The auditor will come and he will ask that you have to go through the exercise of NRV, because as per this standard, you have to record the inventories lower of net realizable value of the cost. So you need to just get the concept of what is net realizable value. This is the estimated selling price less the estimated cost of completion. Then what we will include in the cost of the inventories, all cost incurred in bringing the inventories to their present location. What else? Cost of inventory comprise the purchase price. We will deduct the discounts, rebates, and similar from the purchase price. We will add irrecoverable taxes, transportation, handling, and other costs. And cost of conversion includes the cost directly related to the unit of production, such as direct labor and systematically allocated fixed cost and production overheads incurred in producing the finished goods. Now, these are the things which will be included in the cost of inventory, one important aspect, concept. And lastly, fair value, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants at the moment. Sometimes your inventory might have a different fair value than the cost, so it is also an important concept. Other cost that will not be included was the normal cost of wasted material, labor or other production cost, storage cost, and selling cost. And importantly, IAS 23, the borrowing cost identifies limited circumstances where the borrowing costs are included in the cost of inventories. Means the borrowing cost will be the part of the inventory in very limited circumstances. Then measurement inventory shall be treated at lower of cost and net realizable value, the most important concept. Then recognition as an expense, what inventory is sold, the carrying amount of those inventories shall be recognized an expense in the period in which related to revenue is recognized. In the period in which you recognize the revenue, the carrying amount of those inventories will be recognized as an expense. Means the amount of the inventory which you use, and by using that inventory, you recognize the revenue, you earn the revenue in the same period, it will be recognized. Losses means the write down to the net realizable value shall be recognized an expense and reversal will be treated in the same manner. And lastly, the disclosures, the accounting policy for the inventories, the total carrying amount of the inventory and carrying amount of the inventory is carried at fair value less cost to sell, and any write-off. So this was the nutshell of our last lecture, and we learned these things international accounting standard again at the end. If you want to go for the detailed lecture, I will just put the description of that lecture in the description, so you can find and the detailed lecture of international accounting standard too. Thank you.